Okay, let's unpack this. Think about the market sometimes. They can behave in ways that just seem baffling.
Right, hopefully baffling.
Especially when you look back at periods of intense hype. The late 90s, that whole .com era, is a perfect example.
Oh, absolutely.
There was this incredible, almost feverish investor enthusiasm driven by the shiny new promise of the internet. Companies were going public with business models that, frankly, felt like they were inventing new physics for how businesses work.
Right, like we sell pet food online, therefore we're worth billions.
Exactly. People poured money in, fueled by potential, by vision, rather than necessarily by profits.
Yeah.
And we know how that ended, a dramatic crash when those visions met reality. And existing businesses proved pretty adaptable after all.
It was quite the ride, a time of unprecedented belief in the future, followed by a pretty significant reckoning.
And woven into the fabric of all that excitement, the soaring valuations and the eventual turmoil were sometimes quite technical, seemingly obscure market rules. Rules, for example, surrounding initial public offerings or IPOs.
Absolutely. The headlines focus on the valuations and the hype, but beneath the surface, these mechanics matter. Details hidden away in legal documents can have tangible effects on how a stock trades, sometimes in ways that, challenge our basic assumptions about efficient markets.
And that's exactly what we're digging into today. Our deep dive is all about understanding one of those specific, crucial moments in an IPO's life, the expiration of the IPO lockup.
Right.
What are these lockups? Why do companies and underwriters even use them? And perhaps the most puzzling question the research tries to answer: what actually happens to a stock's price when these restrictions finally lift?
So to get to the bottom of this, we've gathered a stack of sources. We're looking at historical context to understand the environment IPOs launch into, precise financial definitions to clarify the mechanics, and importantly, rigorous academic research papers.
Yeah, the real number crunching stuff.
Exactly. These studies have crunched the numbers and tested theories about what goes on around lockup expiry, particularly in the U.S. market.
Our mission with these sources is to cut through the complexity, the jargon, and pull out the most important nuggets of knowledge, the key insights, and frankly, some surprising facts, so you can be better informed about this specific critical phase in a company's transition to being a public stock.
We want to understand what the data really tells us about lockups and what comes after.
Okay.
So let's start by defining our terms.
Yeah.
What exactly is an IPO lockup agreement?
Think of it as a temporary restraint. An IPO lockup is a contractual agreement, typically between the company going public, the insiders, early investors, and the underwriters managing the IPO.
Right.
It prevents specific individuals and entities who held shares before the IPO from selling those shares on the public market for a set period of time after the company lists.
And the people typically locked up are those who were, instrumental in the company's early life.
Yeah.
The founders, key executives, employees who receive stock or options,
An insider.
and the venture capital or private equity firms that provided early funding. The early money folks.
It's like putting their shares in a holding pen for a while. And the reason for this temporary restriction, why do they do it?
Well, the primary purpose is quite clear and directly addresses a potential problem. Without a lockup, imagine the scenario. The IPO happens, maybe the stock pops on the first day.
Yeah, the classic IPO pop.
And suddenly, all the people who got in early
Mm-hmm.
and have potentially massive paper gains could try to sell their shares all at once.
Ah, okay. A flood of shares hitting the market.
Exactly. A massive, sudden increase in supply. This could overwhelm the demand from new public investors, heavily depress the stock price, and create a chaotic, unstable market for the company right out of the gate.
Right, that wouldn't look good.
It wouldn't be a good look for the company, nor for the underwriters who are trying to ensure an orderly market debut.
So the lockup is basically a way to prevent that immediate selling pressure and potential price collapse.
Precisely. It serves two main goals from the perspective of the IPO process and the underwriters. First, it signals confidence. By agreeing not to sell, insiders and early investors are essentially saying, we believe in the long-term future of this company. We're not just here for a quick flip. This can be, reassuring to potential public investors.
Makes sense. And the second goal?
Second, it provides that crucial period for the market to stabilize, for the stock to find a natural trading price, based on public supply and demand, without the artificial pressure of a large, known overhang of potential insider sales.
Right, letting things settle down a bit.
Right.
So who falls under this restriction? You mentioned founders, execs, employees, early investors.
Yes, those are the main categories. Our sources actually offer a helpful distinction, particularly when discussing international markets like Hong Kong. But it clarifies the different types of early money involved. They differentiate between pre-IPO investors and cornerstone investors.
Okay, tell us about those two groups. Pre-IPO first.
Sure. Pre-IPO investors are the classic early-stage backers. These are the venture capitalists, the private equity firms, sometimes strategic corporate investors, who put money into the company long before it was ready to go public.
Way back when it was just an idea, maybe.
Often, yeah. They invested during the riskier private phase, often across multiple funding rounds, Series A, B, C, that kind of thing. They typically invested on more favorable terms than the eventual IPO price, perhaps receiving preferred stock or debt that converts to common stock at the IPO.
So they took bigger risks earlier for potentially bigger rewards and better terms?
That's right. And because they were early and took those risks, pre-IPO investors often had more than just a financial stake. They might have brought valuable operational expertise, industry connections, strategic guidance.
Right, more than just cash.
Exactly. And often secured significant rights, like seats on the board of directors, or special clauses like anti-dilution provisions, stuff like that.
Okay, got it. They were deeply involved strategic partners, not just passive investors.
Exactly. Now, cornerstone investors are a different beast, particularly prominent in large Asian IPOs. But the concept helps illuminate a specific type IPO participant.
Okay.
These investors typically commit relatively late in the process after the company has filed its listing application, but before the formal roadshow begins and the book-building process sets the final price.
So they're brought in specifically for the public offering itself, closer to the actual IPO date.
Yes. They're typically large institutional investors, think major asset managers, sovereign wealth funds, large pension funds. They agree to buy a significant fixed portion of the IPO shares.
Right.
They invest at the final IPO price, just like other public investors, but here's the key. They are guaranteed their allocation, often on a preferential basis compared to other investors trying to get shares in the IPO.
They're basically anchor investors who provide a solid foundation of demand for the offering, like a guaranteed chunk is sold.
Precisely. Their motivation is almost purely financial. They're large investors looking to build a position in a new public company. Now, connecting this back to the lockup, remember those special rights pre-IPO investors often had, like board seats or veto power?
Yeah.
Our sources point out that these rights generally don't survive the listing. Once a company is public, rules about corporate governance and treating all shareholders equally typically mean these special private rights are terminated or modified.
Okay, so those early perks largely disappear once it's public. The playing field levels out a bit.
Correct. The key right or term that does typically survive the listing process and applies to both pre-IPO investors for their shares converted at IPO and cornerstone investors for their IPO shares is the IPO lockup agreement.
Okay. So both groups get locked up.
Both groups, along with the company insiders, agree to be locked up for the specified period.
That clarifies who is subject to this restriction. Makes sense. And how long does this period usually last? What's typical?
The duration can vary depending on the specific deal, the industry, market conditions at the time of the IPO, lots of factors.
Right.
However, historically in the U.S. market, the most common duration by far has been 180 days.
6 months.
Approximately 6 months, yeah. Following the date, the stock begins trading publicly. Our sources also note that while 180 days is standard in the U.S., lockups in other markets, like the UK, has sometimes been relatively longer.
Interesting. But 6 months seems like the widely cited standard here in the U.S. And if you're an investor looking at a recently IPO'd company, how would you find out the specifics of its lockup, including the all-important expiration date?
Good question. This information isn't hidden. It's a critical term of the IPO agreement and must be disclosed publicly in the company's IPO prospectus.
The big document nobody reads.
Well, the one investors should read.
Yep.
The sources mention that for filings in markets like Hong Kong, you typically find this information in sections detailing the company's history and corporate structure, substantial shareholders, cornerstone investors, and the underwriting agreement. This structure is very similar to what you'd find in a U.S. IPO prospectus, specifically in sections related to underwriting or plan of distribution, and sometimes in the risk factor section. Any potential investor can easily access the prospectus filed with the SEC and find the precise terms of the lockup.
So it tells you who's covered, when it expires.
Exactly. All the details are there.
Okay, so the date is public knowledge. Everyone knows when the lockup expires. This brings us to the core puzzle, the point where efficient market theory seems to hit a speed bump.
Right.
If the date when a massive block of shares could potentially be sold is public information, shouldn't the market simply price in the potential impact before that date actually arrives? Efficient markets are supposed to anticipate known events.
That's the logical assumption, yeah.
Yet the academic research focusing on the U.S. market tells a different story.
This is where the data presents a really intriguing picture. Despite the expiration date being completely transparent and publicly available in the prospectus for months, studies consistently document a statistically significant negative abnormal return around the lockup expiry date in the U.S. stock market.
So the market isn't perfectly pricing this in beforehand. There's an actual dip associated with the date itself.
That's precisely what the research suggests. Several studies, which our sources cite, have examined this phenomenon. Papers by researchers like Field and Hanke, Brav and Gompers, Bradley et al., Brow et al., they've all found evidence of this price decline.
Okay.
Ofek and Richardson, for example, back in 2000, found statistically and economically significant negative abnormal returns, typically in the range of like 1%, 3%, occurring specifically around the lockup expiration date.
Huh. A 1% to 3% drop might not sound like a catastrophe, but for a single publicly known date, that's a noticeable market reaction. It suggests something is happening beyond a perfectly efficient pre-pricing mechanism.
Definitely. It begs the question, why?
Right. What explanations do the sources offer for why this price dip occurs around the expiry date?
The researchers explore a few potential mechanisms that could cause this observed price pressure. One is the most intuitive, simple price pressure.
Okay.
Resulting from a potentially large influx of insider sell orders hitting the market on or immediately after the expiration date. If a significant number of insiders decide to sell simultaneously, the sudden surge in supply could outweigh immediate demand at current prices, pushing the price down.
Okay, that makes sense. More sellers than buyers at the previous price. Basic supply and demand.
A related mechanism suggested is an increase in trades executed at the bid price.
Explain that a bit more.
So when there's a lot of selling pressure, sellers might be more eager to get out and willing to accept the buyer's current bid price rather than waiting for a potential buyer to match their asking price.
They just want to sell, so they take the lower price offered.
Exactly. This results in more transactions happening at the lower end of the bid-ask spread, effectively driving the average trade price down.
So the sheer volume of potential sell orders gives buyers more power, pushing trades towards the bid.
Exactly. A third mechanism discussed in the literature points to the concept of downward-sloping demand curves.
Okay, sounds academic.
It is a bit, but the idea is simple. This theory suggests that for any given stock, investors are willing to buy a certain quantity at a high price, but to get them to hold a much larger quantity, the price has to be lower.
Right, like buying in bulk often gets you a discount.
Sort of. When insiders are locked up, the supply available to the public market is limited. When the lockup expires, a large block of shares previously held by insiders is now potentially available to be absorbed by the public market. To induce the public market to hold this increased supply, the price might need to fall permanently, even if the selling isn't immediate.
So just the potential for increased supply weighs on demand. The market knows these shares could come out.
That's one interpretation. It highlights that demand isn't infinite at a single price point. But here's the truly counterintuitive finding that challenges the simplest versions of these supply-driven explanations.
Okay.
Studies show this price decline around expiry occurs independently of whether insiders actually sell large volume on that specific expiration day.
Wait, say that again? The price often drops even if the big rush of selling that everyone might expect doesn't happen right on that day.
Correct.
That doesn't add up if it's just about immediate supply hitting the market.
Precisely. Researchers like Brow et al., Brav and Gompers, and Ofek and Richardson have noted this. The market seems to react negatively to the event of the lockup expiry, the removal of the restriction itself, not just the confirmed large-scale selling on that specific day.
Yeah.
This suggests the market reaction might be more about anticipating future supply, maybe a signal about the insider's lack of long-term commitment, even if they sell later. or perhaps other complex dynamics related to market microstructure and investor expectations built around this known date.
Wow.
It's not as simple as selling pressure equals price drop on day X.
That is fascinating. It implies a psychological element or maybe a very subtle form of market anticipation or information signaling that isn't just about the physical act of selling on that one date.
It definitely pushes back against the idea that all known information is perfectly and instantly priced in. Markets are complex.
Clearly, given this documented price dip, even if it's modest, does this create an opportunity for external investors? Can you, make a profit by shorting the stock just before the lockup expires, anticipating this drop?
The arbitrage question. Our sources indicate that despite the statistical evidence of a price dip around the expiration date in the U.S., it does not seem possible for external investors to consistently make a reliable profit by trying to arbitrage or exploit this phenomenon.
Really? Why not?
Olfek and Richardson specifically state that their findings do not suggest a violation of arbitrage opportunities.
Why might that be? If the price is predictably dipping, why can't people make money from it? Seems like free money if it's predictable.
Well, there are a few potential reasons drawn from general market dynamics, even if not explicitly detailed in the sources for this specific dip. The effects might be too small after accounting for transaction costs, brokerage fees, the bid-ask spread.
Okay, trading isn't free.
Right. The price movement might also happen too quickly, making it difficult to execute trades profitably at the right moment. Or perhaps the dip isn't perfectly predictable in its timing or magnitude for any single stock, even if it's visible on average across many stocks in academic studies.
So it's an observed pattern in the data, a statistical tendency, but not a clean, easy trading signal for the average investor.
Correct. It's more of a phenomenon to understand the market's behavior around this specific event, rather than a guaranteed profitable trading strategy.
Okay.
It's also crucial to remember, as one of our sources highlights, that this isn't necessarily a universal phenomenon. A study looking at the Swedish stock market,
Sweden,
conducted by Uppsala University researchers, found no significant negative abnormal returns around lockup expiry there.
Wow. So a price dip around expiry is a documented thing in the U.S. market research, but apparently not in Sweden.
Seems that way, according to that study.
What could explain that geographical difference? That's a big difference.
That finding is really important because it tells us market dynamics aren't uniform globally. The difference could be due to variations in market structure, how trading is executed, differences in liquidity, the prevalence of different types of investors.
The regulations?
Could be regulatory differences regarding insider trading or lockups. Or it could simply be different investor behavior, expectations, or confidence levels in different markets. It really underscores the need to look at market phenomena within their specific geographical and regulatory context. Don't assume what happens here happens everywhere.
That's a valuable reminder. So the lockup expiry date in the U.S. seems linked to a curious, perhaps counterintuitive, temporary price dip, even if you can't easily profit from it, and it's not the same everywhere. But the story of insider behavior around an IPO doesn't end on the lockup expiry day.
Not at all.
Our sources also delve into insider trading more broadly and what signals it might contain for investors over a longer horizon.
Right. Let's broaden our scope and look at what the research, particularly the Citi Research Online thesis cited in our sources, tells us about insider trading in general after a company goes public.
Okay.
When we talk about insiders in this context, we're referring to individuals like company directors, senior officers, and large shareholders, people who, by their position, are likely to possess private, non-public information about the company's performance and prospects.
And in most markets, these insiders are required to publicly report their trades, right? Like file a form.
Yes. Regulations require them to disclose their transactions, although the specific rules, definitions of who counts as an insider, and the reporting timelines can vary significantly between countries.
Ah, okay.
Our sources mention differences between the U.S. and U.K. systems. Historically, the U.S. had a broader definition of who was considered an insider and, interestingly, much longer delays in reporting trades compared to the U.K., though legislation like Sarbanes-Oxley in the U.S. has tightened these requirements over time.
And those differences matter for research.
Absolutely.
Oh.
They affect the data available to researchers and thus the findings of studies in different markets. You have to know what data you're working with.
Okay, so acknowledging those reporting differences, what has the bulk of the research found about the information content of these publicly reported insider trades? Do they predict anything about future stock performance?
The findings are quite consistent. across many studies on one side of the coin, insider purchases.
Buying.
Yes, buying. When insiders are buying shares in their own company, it tends to convey a positive signal to the market. It's often interpreted as insiders believing the stock is undervalued or that the company has strong positive prospects ahead.
Makes intuitive sense. They'd know if good news was coming.
Right. And studies have shown that clusters, or significant amounts of insider buying, are often followed by higher future stock returns.
Okay, so insider buys are a potential positive signal. What about insider selling? If people with inside knowledge are selling, that sounds like a red flag, doesn't it? Like, get out now.
This is where it gets nuanced, and it's a key insight from the research. Insider sell trades are generally found to be much less informative about future stock prices compared to buys.
Really? Less informative? Why?
While it might seem logical that selling indicates insiders think the stock is overvalued or the company will do poorly, the research data just doesn't support this as strongly.
Why is that? Why are sells less predictive of future performance?
Well, the sources and the broader research explain this by highlighting the many reasons an insider might sell shares that have absolutely nothing to do with their fundamental outlook on the company's value.
Like what?
Insiders often have a significant portion of their personal wealth tied up in their company's stock. Maybe way too much. They might need to sell for simple reasons unrelated to company performance, to diversify their investment portfolio and reduce risk concentration.
Sensible financial planning.
Exactly. Or to fund major personal expenses like buying a house, paying taxes, funding education, or due to life events like divorce.
Right, just life happening.
Plus, they also frequently receive stock options as part of their compensation. When they exercise these options, they often immediately sell some or all of the resulting shares, not because they lack confidence, but simply for liquidity or diversification. It's part of their pay package realization.
So a sell could just be, I need cash, or I'm already overexposed to this stock, not necessarily, the ship is sinking.
Exactly. The research concludes that because there are so many plausible, non-value-related reasons for insiders to sell, a sell trade is a much weaker signal about the company's future prospects than a buy trade. A buy trade is usually driven by a belief that the stock is a good investment. Selling has many potential drivers.
That's a crucial distinction for investors to understand. Don't panic on every insider sell. Does anything influence how informative a trade is, even a buy? Are all buys equal signals?
No, not necessarily. The research finds that the market reaction to insider trading, and therefore its potential informativeness, is strongly influenced by the company's characteristics, specifically its market-to-book ratio and its size.
Market to book.
Yeah.
Right, that's the market value compared to its accounting book value, often used to separate growth stocks from value stocks.
Correct. High MB companies are typically seen as growth or glamour stocks, trading at premium to their book value, often based on expectations of high future growth. Low MB companies are considered value stocks, trading closer to or below their book value.
Okay.
The research identifies that insiders tend to behave as contrarians in their overall trading patterns.
Contrarians, meaning they go against the crowd, buy when others sell.
Pretty much, yeah. They tend to be net buyers when the market, or a specific stock, has gone down significantly in bear markets or after periods of poor performance. Conversely, they tend to be net sellers when the market or the stock has performed very well in bull markets or after large price run-ups.
So they buy low and sell high from their perspective, acting on perceived mispricing.
That aligns with the contrarian description. They tend to buy shares in companies or sectors classified as value stocks, low MB, that have underperformed, and sell shares in glamour stocks, high MB, that have performed strongly. This suggests they are trading on perceived mispricings or based on their longer-term view that differs from current market sentiment.
Interesting. And company size matters too, you said.
Size is arguably the most significant factor determining the informativeness of insider trades. The research consistently shows that insider trades, particularly buys, are much more informative and have a stronger impact on stock prices in small companies compared to large, widely followed companies.
Why is size such a critical factor, more important than MB?
Well, this finding aligns perfectly with the concept of information asymmetry.
Okay, meaning how much private info insiders have versus the public.
Exactly. In smaller companies, there's generally less public information available. Analyst coverage might be limited, news might not travel as quickly or be as widely disseminated as it is for large blue-chip corporations.
Right, less scrutiny.
So insiders in these smaller firms are far more likely to possess material non-public information that isn't already factored into the stock price. Therefore, When an insider, especially in a small company, makes a significant trade, it provides more new information to the market.
Making the trade a stronger signal.
Exactly, more predictive of future performance. In large, well-covered companies, most information gets out fast, it's quickly public, reducing the unique informational edge insiders might have. So their trades are often less informative on average.
That really clicks into place. Higher information asymmetry in smaller companies means insider trades reveal more. So putting it together, insider buying, particularly in smaller, potentially undervalued low MB companies, seems to be the most compelling insider signal to watch, according to the research.
That's a fair interpretation of the general findings, yeah.
Okay, now let's bring this insider trading discussion back to the lockup period itself. The lockup agreement restricts insiders from selling, but does it completely stop all trading? Do any trades happen before the lockup expires?
This is another interesting detail revealed by the research. Our sources indicate that studies do find evidence of early trades.
Early trades.
Insider transactions occurring within the formal lockup period. These trades are presumably allowed under specific circumstances, usually requiring the explicit written consent of the underwriters who manage the IPO.
Ah, so it's in the fine print of the lockup agreement.
Usually stipulated in the lockup agreement itself, yeah.
So the lockup isn't an absolute unbreakable barrier. Insiders can get permission to trade early. The underwriters can grant exceptions.
It appears so, under specific conditions and with underwriter approval. The research looking at these early trades found that the probability of such trades occurring was higher in IPOs that used prestigious underwriters.
Like the big-name investment banks.
Yeah, and also higher in IPOs with longer lockup periods.
That's an interesting correlation. Does having a more prestigious underwriter somehow make early releases more likely? Maybe they have more clout or flexibility.
That's a possible interpretation. Perhaps more experienced or prestigious underwriters have more flexibility, different internal policies, or maybe they see granting early releases as part of their ongoing relationship management with the company or key insiders.
Or maybe it signals something about the quality of the IPO itself.
Possibly. The sources don't explicitly state the reasons behind the underwriters' decisions to grant these releases, just the correlation.
Okay. And the findings about when these early trades happened relative to the stock's post-IPO performance are quite telling, aren't they?
Yes, they provide insight into the context of these early transactions. The studies found that early buy trades, insiders buying shares during the lockup period.
Buying before they're allowed to sell.
Right. These tended to occur in IPOs that had underperformed since going public.
Okay, so the stock price has maybe dropped or traded flat after the IPO, and insiders are stepping in to buy before their lockup is even up.
Yeah.
That fits the contrarian idea again, or maybe it's a signal to try and support the stock price and show confidence in an underperforming IPO.
It certainly aligns with that. It could be insiders genuinely seeing value after a price dip or a strategic move, potentially encouraged or at least permitted by underwriters who want to see the stock perform better.
Makes sense. And the flip side, early sells.
Conversely, early sell trades insiders selling shares during the lockup, again with permission, tended to occur in IPOs that had overperformed since listing.
Taking some profits off the table in a successful IPO run with the underwriter's blessing, cashing in early when the stock's hot?
That seems to be the likely scenario. This pattern suggests that underwriters might be strategically selective about granting early releases from lockups.
Right.
They might be more willing to allow insiders to sell in IPOs that have done very well, perhaps to let them realize some gains or manage the risk.
Keep the insiders happy.
While being more restrictive on selling and perhaps more open to allowing buying in IPOs that have struggled, potentially as an effort to stabilize the stock or signal confidence.
So the lockup period isn't just a passive waiting period. There can be active strategic trading happening within it, potentially influenced by the stock's performance and the underwriter's decisions. That adds a fascinating layer to understanding this phase.
It certainly complicates the simple picture of everyone just waiting for day 181, doesn't it? It really does. All right, we've covered the mechanics of lockups, the interesting price dynamics around the expiry date, and the signals from insider trading, both generally and within the lockup period. Now let's take an even broader view and look at the long-run performance of IPOs.
Okay, the bigger picture.
How do these stocks typically perform over months and years after they first go public? Is buying IPOs a good long-term strategy?
This is another major area of research, and the general finding from studies on the U.S. market is quite notable and perhaps sobering for investors caught up in IPO excitement.
IPO.
Sobering how?
Across various time periods and methodologies, IPOs as a class tend to underperform relevant market benchmarks over the long run.
Underperform. So buying an IPO and holding it for a few years has historically often resulted in worse returns than just buying, say, a broad market index or a portfolio of similar already listed companies.
That's the finding on average, yes. Our sources cite some pretty stark figures. For U.S. IPOs issued between 1980 and 2001, studies show an average underperformance of around 23% over the following 3 years.
23% less than the benchmark? That's significant.
It is. And when you look specifically at the period of peak bubble irrationality, the 1999-2000 timeframe.
Back to the dot-com craziness.
Right. The underperformance was dramatically worse. One study using style-adjusted returns, meaning they accounted for factors like size and value, found an average underperformance of a stunning 61.2% over 3 years for IPOs from that era.
Wow. 61% underperformance. That brings us right back to our initial point about the dot-com bubble, doesn't it? The hype can lead to real long-term pain.
Absolutely. That period was characterized by massive investor enthusiasm, a huge volume of IPOs, and sky-high valuations based on projections rather than current reality.
Right.
This long-run underperformance, especially pronounced during hot markets or bubbles, is strongly linked by researchers to the market timing or investor sentiment explanation.
Okay, tell us more about that theory, market timing.
The idea championed by researchers like Lockup and Ritter is that companies and their underwriters tend to bring firms public when the market is feeling particularly bullish, sometimes overly bullish.
Strike while the iron is hot.
Exactly. During times of high investor optimism, like the peak of the dot-com bubble, investors are more willing to pay very high prices for the promise of future growth. According to this theory, the IPO is priced too high initially because of this, let's call it, irrational exuberance.
Okay.
Then, over the next few years, as market sentiment normalizes, as more information about the company's actual performance becomes available, or as the bubble bursts, the stock price falls back towards a more realistic long-term value.
Resulting in underperformance for those who bought into the initial hype.
Exactly. So companies go public when the getting is good, when investors are willing to pay top dollar, which kind of sets the stage for future disappointment.
That's the core idea behind the market timing explanation. Makes sense. Any other reasons?
Another potential reason for long-run underperformance discussed in the sources relates to agency costs.
Agency costs.
After an IPO, founders, executives, and early investors often sell a significant portion of their shares, either at the IPO or after the lockup. This reduces the percentage of the company's equity that they personally own.
Right, they cash out some of their stake. Less skin in the game for the people running the company.
Exactly. The argument, drawing on classic theories, is that this reduced managerial ownership can potentially increase agency costs. These are the costs and inefficiencies that arise from the potential conflict between the interests of managers and the interests of dispersed public shareholders.
How so?
If managers hold fewer shares, they might be less incentivized to maximize firm value for outside shareholders and potentially more inclined to pursue their own interests, like perks or empire building, which could lead to suboptimal decisions and poorer long-term performance for the company.
That's a powerful idea, ownership percentage influencing managerial behavior and long-term results.
It's a well-established concept in finance. A third explanation points to the inherent characteristics of the companies that typically go public via IPO.
What kind of characteristics?
Many IPOs are relatively small, young, high-growth companies. Research has shown that, as a group, small, high-growth stocks have historically tended to underperform over the long term compared to other categories of stocks, such as large-cap value stocks. Think of the Fama French research here.
So some of the underperformance of IPOs might simply be because they belong to a class of stocks that, on average, hasn't performed as well long-term, regardless of the IPO process itself.
That's the argument. It's likely a combination of these factors, market timing and sentiment, potential agency costs from reduced insider ownership, and the inherent characteristics of the firms going public that contribute to the observed long-run underperformance.
It's complicated.
And it's also worth noting that measuring long-run performance is complex. Results can sometimes differ depending on the benchmark used or the statistical model applied, like using style-adjusted returns or multi-factor models. It's not always straightforward.
Understood. How does the insider trading we discussed earlier connect back to this long-run performance picture? Does insider activity after the IPO tell us anything about how the stock might do years down the road?
This is where insider trading insights become relevant again. The research finds that IPOs where insiders are active in trading after the initial public offering tend to perform better in the long run compared to IPOs where insiders are not trading at all.
Wait, that seems counterintuitive again. You'd think less insider selling might be better for long-term performance. Why would more insider activity be associated with better long-run performance?
It aligns with the idea that insider trading, when done on the basis of private information legally, of course, can help the market price the stock more accurately over time. It helps reduce that information asymmetry we talked about.
Okay, so informed trades help price discovery.
Exactly. If insiders are making informed trades, their activity could help the stock price converge more quickly towards its true fundamental value. More specifically, the studies find that IPOs with significant net buy activity from insiders after the IPO.
More buying than selling by insiders.
Right. Where the volume of insider buying outweighs selling over a period, these tend to perform better over the long term than those with net selling or no insider trading.
Okay, so it's not just activity, it's the direction of the activity. Net buying post-IPO seems to be a positive long-term signal, generally.
On average, that's what the data suggests. However, and this highlights the complexity of financial research and measurement, one specific finding mentioned in the sources using a particular methodology, the Fama-French alpha.
A specific way of measuring risk-adjusted return.
Right, which attempts to isolate returns beyond standard risk factors. That analysis presented a seemingly contradictory result. It noted that in that specific analysis, net sell IPOs appeared to show positive long-term alpha, while net buy IPOs showed negative alpha.
Wait, the exact opposite of the general finding. Net sellers outperformed net buyers in that one analysis. How does that happen?
Yes, and this illustrates a critical point. While the overall body of evidence generally suggests insider buying is a positive signal, specific studies using different methodologies, time periods, or focusing on different market segments can sometimes yield results that seem conflicting.
So the measurement method really matters.
It does. It doesn't necessarily invalidate the broader findings, but underscores that financial markets are complex, and different analytical approaches can reveal different facets of the data. It's a reminder that no single metric or study provides the complete, simple answer. You have to look at the context.
That's a valuable lesson. Always look at the broader picture and understand the nuances of the analysis. Don't just grab one number. What other factors influencing long-run IPO performance do the sources highlight?
A few other key findings from the research stand out. First, the degree of initial underpricing, that pop or jump in price on the very first day of trading compared to the IPO price.
Yeah, the big first-day gain everyone gets excited about.
Right. Paradoxically, that's associated with worse long-term performance. The bigger the initial first-day gain, the more likely the stock is to underperform over the following years.
Wow, so a huge pop might actually be a bad sign long-term.
According to that research, yes. Second, as we discussed, being issued during a hot market or a period of high IPO volume, like 1999-2000, is strongly associated with significantly worse long-term performance. The environment the IPO launches into matters immensely.
Don't buy IPOs in a frenzy, got it.
And third, interestingly, the length of the lockup period itself does not appear to be consistently associated with better or worse long-term performance.
So a 180-day lockup versus, say, a year-long one doesn't predict long-term success.
Doesn't seem to, based on the study cited. A longer lockup doesn't seem to magically protect the stock from the general tendency towards underperformance in the years that follow.
That's a lot of interconnected factors influencing the long-term fate of an IPO. The initial pricing, the market sentiment at the time of issue, and the subsequent behavior of insiders. The lockup length itself seems less important than these other dynamics for the long run.
Exactly. The lockup is a critical event in the short term. That expiry date matters, but its duration doesn't seem to dictate the multi-year trajectory.
Okay, we've really gone deep here, from the definition and purpose of lockups, through the surprising price dynamics around expiry, the nuanced signals from insider trading, and the challenging landscape of long-run IPO performance, all informed by research. Let's try and bring this all together. What does this mean for you, the listener, who might be looking at investing in companies that have recently gone public? What are the key takeaways, the nuggets of insight from this deep dive?
Okay, let's boil it down. First, understand that IPO lockup expirations, at least based on the U.S. market research, are associated with a documented, albeit often temporary and modest, price pressure around the expiry date.
That 1-3% dip possibility.
Right. It's not perfectly priced in by the market beforehand in a way that makes it disappear completely. This event represents a potential shift in the supply dynamics and liquidity of the stock. While it's not presented as a clear, profitable trading strategy, being aware of this historical pattern is important context. Don't simply assume the market is perfectly efficient regarding this public date.
It's a known potential volatility point to keep on your radar, something to be aware of.
Right. Second, pay attention to insider trading activity after the IPO, as publicly reported. These signals are complex and shouldn't be followed blindly, but they offer valuable, nuanced information.
Especially the buys.
Exactly. The research strongly suggests that insider buy trades are generally more informative and predictive of future positive performance than sell trades. Pay particular attention to insider buying, especially in smaller companies or those perceived as value stocks, low MB, where information asymmetry is higher and insider knowledge is likely more unique.
And don't overreact to selling?
Don't read too much into routine insider selling, as it's often for non-value related reasons like diversification or taxes.
So insider buying, especially in smaller IPOs or those trading at lower valuations post-IPO, could be a signal worth investigating further, a piece of the puzzle.
That's what the research implies, yes. Third, approach long-term IPO performance with realism and caution. The historical data for the U.S. market shows that, on average, many IPOs underperform market benchmarks over several years.
Remember the dot-com lesson?
Remember the lessons from periods like the dot-com bubble. Initial hype and market sentiment can lead to overvaluation that unwinds later. When considering an IPO for the long term, look beyond the initial excitement and the first-day pop.
Focus on the fundamentals.
Focus on the fundamental strength and business model of the company. Assess the overall market conditions at the time of the IPO as it issued into a frenzy. And continue to monitor insider behavior, particularly net buying versus selling activity over time, as it can provide clues.
Fundamentals, market context, and watching for insider buying seem key for the long haul.
Precisely. And finally, remember the geographical differences we noted. The phenomenon of a price dip around lockup expiry, while documented in U.S. research, wasn't found in that Swedish study.
Right, the Sweden example.
This highlights that financial market dynamics and investor behavior can vary significantly across countries and regulatory environments. Don't assume findings from one market apply universally. Always consider the specific context.
That geographical difference is a crucial point to keep in mind for any market analysis, not just IPOs.
Absolutely. Context is key.
So let's quickly summarize the core insights from our dive. We've learned that IPO lockup expirations in the U.S. have been associated with a documented price dip around the expiry date, a phenomenon that isn't fully explained by simple, immediate selling pressure and isn't observed everywhere, like Sweden.
Sure.
We've seen that insider trading signals are nuanced, with insider buying, particularly in smaller value-oriented firms, often being more informative than selling.
Got it.
And we've tackled the complex reality of long-run IPO performance, which shows a historical tendency for underperformance in the U.S., influenced by factors like market timing during bubbles, potential agency costs, and the characteristics of the companies themselves, with insider activity potentially playing a role in how quickly information is incorporated into prices.
It's a multifaceted picture, isn't it? Showing how various structural features and participant behaviors interact to influence a stock's journey from private to public.
It really is. Which leaves us with a final thought, a question for you, the listener, to ponder. Given that even publicly known scheduled events like a lockup expiry date can still be associated with observable market anomalies that challenge simple efficiency, and given that signals like insider trades carry such nuanced, sometimes conflicting information, how much of a market's true underlying information, the real insights about future value, is ever truly accessible and straightforward for the average public investor?
That's a deep question.
Does navigating this inherent complexity simply represent unavoidable risk, or does it perhaps create unique opportunities for those who are willing to truly dig deep into the data and look beyond the obvious headlines and hype?
A question that perhaps encourages more deep dives.
Indeed. Thanks for joining us for this exploration of IPO lockup expirations. We hope this deep dive has given you a clearer perspective on this important market event.
Keep asking questions, keep exploring the fascinating world of finance.
We'll see you on the next deep dive.